My guess is you've probably heard about asset bubbles and crashes. And along that line, you've probably heard about the Dutch Tulip Bubble. What was the story behind that? And what are some of the lessons that we could learn from the tulip mania? In the 1600s, the newly formed Dutch Republic was enjoying unparalleled economic success. And it was also because they were very innovative and very creative. They invented the stock market and the stock exchange. Their middle class was booming and growing in this era. But human nature. Just like every generation of rich people in history, they sought after the most expensive things that money could buy to show off their wealth. Today we think about things like luxury yachts, supercars, but back in the 1600s, one of these status symbols was exotic flowers. Now, in case you didn't know, tulips are flowers with petals that are intensely saturated with colors. Tulips were not native to Europe, so that means they were pretty exotic. If you had them in your garden, that would symbolize that you were very wealthy and that you were somebody important. So because owning tulips was kind of like seen as a status symbol, so its popularity and demand was growing in the 1600s as the economy was growing and people were getting richer. Now the thing is that tulips can take 7 to 12 years to grow from a seed. So there was a limited supply because you kind of have to wait for the tulip to grow. Also, they were quite fragile, so they had to be cultivated and handled very carefully or they would die pretty easily. So to manage the supply shortage, the Dutch came up with a new invention. Let's say I want to buy some tulips today, now, but there aren't any to be found. So I could make a deal with a tulip farmer. So the tulip farmer and I, maybe we sign a contract. So in this contract, he promises that he will deliver me 100 tulips when they have grown. So this could be a few years from now. And for this contract today, I will pay him maybe 100 florins. Those are like gold coins back in the day for each of these tulip flowers. Now let's say 1 year later, the price of the tulips have increased from 100 florins to 200 florins. My contract is still valid. I could wait until the end of the contract to receive the flowers from the tulip farmer. Or if I want to cash out today, I could simply just sell my contract to somebody else. Now, because the price of tulips have increased, the value of my contract has also increased. I could simply make a 100% profit on my contract without even ever having owned the tulips. So this was the beginning of what we know today as futures contracts. It was invented by the Dutch in this era to take advantage of the rising prices and the limited supply of tulips. So more and more people were getting into the tulip futures contracts, and that made the prices of tulips increase even faster. Every day, people were hearing more and more stories about their friends, their neighbors, who were making a lot of money from buying and selling these contracts. So more and more people wanted in on the action. And many of them, in fact the majority of them, they didn't even want the tulip flowers. They were just speculating on the price. They were just buying and selling the contracts simply because they expected the prices to keep going higher. And higher it went. It came to a point where some of the most exotic tulips could cost over 5,000 florins per flower. In today's money, that's like 750,000 US dollars. Can you imagine paying 750,000 US dollars for one single flower? That costs more than a house. I mean, it costs more than my house. That is more than several years of an average salary. Now, because it had gotten so expensive, in order to buy these contracts, people actually had to take on leverage. And they did. They borrowed money to continue buying these contracts because they were speculating and expecting that there's no ceiling, there's no end to how high the prices can go. At some point, it got ridiculous. At some point, people began to realize that nobody is going to be buying flowers at such insane prices. And so by February of 1637, it was over. The market for tulips fell apart completely the prices tanked and never went back up again. People who had bought at the highs, they lost their investment. People who had taken on leverage or they had sold everything just to hop in on this bandwagon, if they had gotten too late and they had not exited in time, they pretty much would have lost everything. What are 3 lessons that we learned from Tulip Mania that we can apply in our investing today? The first lesson is that you need to have a good reason for making an investment in anything. If you want to invest in any asset, be it a stock, a cryptocurrency, luxury handbag, you need to ask yourself, why is this a good investment? How do you know how much it's actually worth? What is the intrinsic value of this investment? Now, why were people willing to pay $750,000 for flowers? Initially, it started out as a status symbol. It was a thing about pride. And then it became purely speculative. People were rushing in to buy the flowers, to buy contracts on the flowers, only because they expected that they will be able to sell them at a higher price later. Everyone around them was making money and they didn't want to miss out on the opportunity to perhaps make a fortune. Now, did some of them make money? Yes. But is it a sustainable way of making money? No. When a bubble bursts, the prices of the asset will fall very dramatically. The people who get in last have a pretty good chance of losing everything. So if you want to invest in anything, any asset, make sure you do your homework, do your research, make sure you know what exactly you're investing in. Make sure you know what is its true value. Don't just go in simply because everybody is also doing it and everybody thinks that the price is going to continue to increase. That is not a valid reason to invest. The second lesson that we learned here is that derivatives are a double-edged sword. Now, in our story today, at the height of the Tulip Mania, majority of the people were not investing or trading the flowers themselves, but contracts on the flowers. And many of these people had taken on leverage to trade these contracts. Leverage and derivatives have many usefulness. They can help us to deploy capital more efficiently, and they can really help us to multiply our gains. But this multiplier effect also applies to our losses. If we are wrong, we have the potential to lose everything. So if you're going to use leverage, if you're going to use derivatives, make sure you understand the risks involved and you have a system in place to mitigate and manage those risks. The third lesson we learned is that history will always repeat itself. You know, we like to think that we have learned the lessons from the past, or how we today, we are better, we are smarter. You know, the 17th century Dutch people, they were foolish, they were greedy. This time, things are different. These are famous last words. Throughout our history, we have seen many examples of bubbles. Some of the more famous examples we can think of are the dot-com bubble, the housing bubble. And today I would say that I see bubble-like symptoms in a new and upcoming asset class that is seeing insane valuations and attracting the interest and the investment of many people who don't understand it. People who are simply rushing in to buy because they expect prices to continue increasing. But look, I am not anti-innovation. I believe there's a use case, in fact, many use cases for a number of these new innovations, these new asset classes, and the technology that is behind it. Now, I believe there's a compelling case that some of these new products, new projects, new technologies will solve real-world problems, and there's a good chance that they will enjoy long-term success. Some of these products, some of these new asset classes and projects, I believe that they will increase in value in the long term. But as it is today, we have seen how in recent years, people have been buying some cryptocurrencies, NFTs, and even some stocks at ridiculous prices. And if you ask them, why are they doing this? If you ask them to explain what is blockchain, they have no idea. They have no clue. They simply bought because prices are going up and everyone thinks that the price can go even higher. They simply bought because every day they were hearing stories, they were reading these stories on social media about people who became overnight millionaires, and they didn't want to miss out on the action. Now, these are symptoms of a bubble. So that's all for today's video. I hope you learned something from this history lesson that can help you to think about how you're going to make your investment decisions moving forward. Do like, comment, subscribe if you found it to be helpful, and I will see you in the next video.